recent trends in 2025's outlook, the financial markets have experienced a significant bout of volatility recently, and several factors suggest this trend can likely continue through the first quarter of 2025 before potentially stabilizing. Key contributors to this volatility include the Federal Reserve's comments around a slower rate-cutting cycle, potential incoming tariff policies, and inflationary pressures affecting long-term Treasury yields in 2025. The Federal Reserve has implemented a series of rate cuts in 2024, including a recent 25 basis
point reduction.
However, the Fed and economists predict that the pace of rate cuts will slow in the first half of 2025. This cautionary approach is due to the Federal Reserve nearing its neutral rate, where monetary policy neither stimulates nor restricts economic growth. While there is uncertainty surrounding future government policies and governance practices, particularly with the new administration set on making waves with changes, adds to the uneasiness around future predictability of inflationary pressures. The Fed will likely have to wait and see what future administration policies are enacted on before getting a clearer picture of the path forward. The incoming administration has talked strongly about imposing new tariff policies on those that don't comply with their demands, which have and are expected to add further market volatility. Historically, tariffs have led to immediate gains in stock prices as investors reap the short-term increases. Over the long term, though, reassessment of the impacts tariffs have on companies reliant on imports and exports paints a much different picture. The likely potential for retaliatory tariffs and disruptions in global trade further exacerbates market uncertainty, leading to correctional periods to formate in the markets. Inflation remains a significant short-term concern into 2025, pressuring Treasury yields to remain elevated. A recent increase in yields reflects the threat of persistently higher inflation above the Fed's 2%, which leads to an appetite for higher returns moving forward. While the Fed's recent 25 bps cut has temporarily tamed long-term Treasury rates, the overall trend suggests continued upward pressure on yields. This dynamic creates a challenging environment for both equity and bond markets as investors weigh in on both prospects.
Given these factors, market volatility is likely to persist through the first quarter of 2025. The combination of slower rate cuts, tariff uncertainties, and inflationary pressures will keep investors on edge as the new administration looks to take over in the latter part of January. As the year progresses, there is potential for stabilization if inflation shows further signs of easing and the Fed's policies guidance provides a clearer path. However, the notion of increased tariffs, potentially leading to a tariff war on goods by allying nations with the US, will begin to weigh on consumers and businesses in the second half of 2025, starting a correctional period to formulate in the markets. The current market volatility experienced has been influenced by speculation on complex interplay of trading policies and inflationary persuasion on monetary policy in 2025. Investors should brace for continued fluctuations in the near term, but remain hopeful for a more stable environment after trading policies have shown a new path forward.